On today's Positively Sloped, the market is rotating into some other sectors. We cover Costco's earnings report and what that means for the high-end consumer, as well as the labor market. And finally, we wrap up with an NFL and NCAA playoff preview before sending you into the last episode on Christmas Day. All right, let's talk shop. Today is Tuesday, December 16th. And Scott, 2 more weeks left in the year. We're right around Christmas time and New Year's. It's a beautiful time to be alive. We're getting through the Chicago cold. I think we got 30s and 40s on the docket for the rest of the week here. Kind of beat the blob of the 0 degrees and 5 degrees or so that the Bears played and won in on Sunday. And how are you doing today?
Oh, Jake, that's nice of you to ask. I'm not sure. You have to get back to me for that answer. But yeah, beat the blob, beat the blob, that is the cold, beat the beast. I'm going to predict that we're going to stay in the 30s and 40s for the rest of the year, Jake.
Oh,
and
beautiful.
That might mean some warmer pastures for the markets too here, because gosh, do we need them.
Yeah, we do. And we've seen a little bit of a comeback off of that government shutdown, reopening November 20th, now a month in the rearview mirror. But let's start with the markets. And I think one of our favorite topics to make fun of media pundits on is the rotation, where every day if we get a red day, we say we rotated, the AI trade is dead, mega caps are dead, we're on to bigger and better things. But I think that might be true now, Scott. I'll just hit you with some stats real quick. Last year, the Mag 8, so including Broadcom, the attribution on the S&P 500 was 65%. The year to date so far this year, 45%. In the last 3 months, 29%.
Ouch.
So we're starting to see a broadening out finally, outside of the Mag 8 and the AI trade and all of these mega deals that we've seen. Do you think we finally rotated and are in for a rotation, or do you think this is a blip on the radar? We'll be right back to where we started soon.
We'll be right back to you after these few programming notes. Here's the thing.
Back to the regularly scheduled
back to
program.
regular programming, blah, blah, blah. Go get your snacks and your drinks, and we'll be back in a few minutes, 2 and 2. So the funny part is making fun of the pundits and everything like that. And you did hit me with some stats there and also hit my arm as well. So don't do that again. You did it again. And that's great, Jake. You're listening well today. It's like the media pundits. So we're on a red day. It's as we tape this, like you mentioned the date and the time. It's like, so now we're a red day. And now the markets are down and the pundits are all upset about it. So we're having this red day. Red's your favorite color. I don't care because the markets are going bad. Yes, right here. Look at this beautiful ensemble. And now it's because of the attribution still being in that. So the broadening out means the markets do go up in the sense of like NASDAQ, not so much, but maybe the S&P, the Dow off a fresh high just recently because we have that broadening. But if you look at like the NASDAQ and look at the media pundits that are out there, we're facing Armageddon.
Yeah.
Because all of a sudden the AI trade is now the thing that's turning over while everybody wanted this broadening.
Yep.
That was like this whole, there was this whole harbinger of like a better marketplace because of the fact that we're going to get more industrial participation, easy for me to say, more financial participation, more say consumer discretionary participation, telecom. And we're getting it. And now everybody's upset. A lot of people, the media pundits are, especially some of the papers and so forth. Point being, if that happens, I think it's going to take a little bit more time for the average trader, average investor to get used to this, which is fine because that to me makes the trade itself more interesting and means that there's going to be more of a bump in the start of this whole thing and the rotation, if you will, which makes me think of chicken for some reason. The rotisserie. As rotisserie goes along, great rotisserie at Costco, good rotisserie chicken, had some on the weekend. They would end up being more of a boost to those stock prices as far as the money that flows in, especially if people don't believe it, as far as the rotation or the rotisserie into the chicken sandwich.
Yeah, I'm a little more bought into this rotation. I mean, I've been saying for a couple months we need some sort of breath, some sort of pullback. We did have that across the markets, but we're now on 5 months of the Dow outperforming the S&P. Yeah. And 3 months of the Dow outperforming the NASDAQ. So we have had that broadening out, if you will, where some other sectors are starting to shine. The Dow in the last 3 months led by Goldman, Caterpillar, Johnson & Johnson. So you've got 3 different sectors right there and brought down a little bit by your Mag 7s, by Amazon and NVIDIA.
Which looked terrible most of the year. I mean, Johnson & Johnson, if you look at the chart on J&J over the last, say, let's see, up until basically May or June, just a disaster. It wasn't going anywhere. And the markets were taking off on Johnson & Johnson. Goldman did a little bit better. I mean, as far as the financials, similarly, had some struggles around some of the bank worries, but then just took off in the last couple months. So it's funny how you mentioned it. You're right. And being bought in is a smart way to put it, because if you are bought into that rotisserie trade, the rotisserie chicken trade, you're getting rewarded big time. I mean, you're getting some major outperformance in some of those names you mentioned just for hanging on to them through this tumult that was going on for most of the year up until, say, June or July.
Yeah, it's about time. And we covered the Q3 financials earnings last month and how strong they were across the board. And that was led by Goldman and basically all of their different product lines having year-over-year growth. And we've seen that flow through into the stock price. I think this is healthy. I think if we end the year in these last 2 weeks continuing this rotation with, I think you can get the market kind of meandering upwards with, this is the last full trading week of the year. Next week will be short because of Christmas and then New Year's. And so there's just, we talk about the emotionality around the holidays. It's real as much as it shouldn't be, but I think we'll get some positive market movement over the next couple weeks, and I think that'll be spread out across sectors. I mean, I don't know that there's not a ton of scheduled data points left. We typically see every day something pops up, and especially right now with these Mag 7 stocks and tariffs. Every single day, something's coming up that NVIDIA is now going to sell H200s to China. Now they're banned. Now the deal with, the UK is falling through. So there's still news to be had over the last 2 weeks. But I think for the most part, there's not a lot of headwinds. I think we'll just kind of meander upwards for the last couple weeks, and that broadening will continue into next year, which I think sets us up really well for a fourth consecutive good year in 26.
Let's hope. And I agree. The way we're probably going to get that good year is probably that broad-based rotation or broad-based fever, because the AI stuff is great. I love the AI trade. We've been benefiting in that with a lot of our portfolios, but let's face it, that can only go so far. I mean, it's gone crazy. The thing that worries me a little bit though is, you look at like the job numbers. You talked about, catch up in data. You had a jobs numbers out this morning, non-farm payroll reports catching up to the shutdown period, and it's like you're seeing job numbers okay. Unemployment's at like 4.6%. Job numbers are only averaging now, somewhere around that 100,000-ish level, where it's strong enough to keep things going, but it's not strong enough to suggest that the economy is like going crazy as far as job creation. It's probably more of a seasonality thing. It's probably the fact that the BLS is just upside down when it comes to calculations. That's a Donald Trump sort of quote. And the fact that we need to just blow everybody out there and get new people to get the right numbers in there. Whatever it is, the job numbers, if you hear from just friends of ours, anecdotes from even people that we know, it's like, and friends if you have them, is like they are not getting jobs. Like there's a lot of consternation in the job market right now with regards to who's hiring, who's firing. And then you have all these announcements from some of these companies that are getting them out there before the end of the year saying we're going to have layoffs in tech land too, which is kind of interesting. So we'll have to just see how that pans out. I think it's more of a head fake than anything. I think you're right about looking at historic rotation, as we've seen, especially at the end of the year, has signaled more good forward returns to come and more broad-based returns to come as well, if it happens in this period of Q4. So keep that in mind, boys and girls, as you go into Q1 2026. The follow-through is going to be pretty big and pretty big deal if it's going to be real.
I like that. I like that. And you mentioned the labor report we got this morning. A little bit of a good news, bad news sort of situation where we had November. This is now the delayed number that we get for November, so we're finally caught up. Added 64,000 jobs in the labor force, but the as you mentioned, unemployment rate's up to 4.6%, the highest in 4 years. So we added jobs, yet there's more people in the labor force that, like you said, can't find a job or aren't looking at the right jobs, or maybe there's jobs open that people don't want. Whatever the situation may be, it was a little good news, bad news, where you had job creation, and then as we've seen be the trend this year, October was revised down again. So we now have a 105,000 job loss from October. That is pretty attributable to 162,000 jobs cut from the government
shutdown.
in
There
October.
You go, shocker.
And again, though, August and September revised down. August is now finalized. So the labor market is weakening. It's been weakening all year. So what do you make of the labor market versus the inflation kind of dynamic dichotomy right now?
So weakening is an interesting word to use because it seems let's stay on the rotisserie mode. The labor market to me is just rotating into those folks that are now considering themselves out there looking for a job when maybe they weren't before. Because if you look at a number within the employment sector, which we do, because you have to look behind the data some more, because the data is large, it's big, it's goofy. Like if you look at the U6 number, which is basically the total unemployed number, which has people marginally attached to the workforce, people that are part-time for economic reasons, it tries to get some of these gig economy people as well, because they're folks that are basically in the labor force, but they're not really, and they could be having a part-time job. The point is that number is 8.7%. That number's always been higher than the U4 number, always been higher than the employment number, okay? But here's the thing. That number is also at an all-time high or in this last rebound. And so that's coming from, say, last year at this time about 7.4. So you're looking at 8.7 to 7.4. That's a pretty big increase, meaning there's one of two things happening there. And I think it's the following. Folks are considering themselves more looking for work, more willing to work, more being out there trying to find a job and can't, versus those that weren't before, meaning that they weren't really motivated, or maybe there weren't jobs out there that they thought they could get. There's going to be some catch up there. There's going to be some workaround in the number, because some of those numbers don't cut the mustard, ketchup mustard. If you think about where the economy is, if it is that strong, those numbers shouldn't be increasing like that, is my point. If the numbers are as bad as they are, if they're increasing as they are, where there's that much unemployment increasing and showing up, the economy is not really growing that fast to create all these jobs that really aren't there, is what that is telling me.
You're hungry this morning, so let's give us a little history lesson here. You said that U6 is always higher than the U3, and they're both at all-time highs right now. Or which one is it?
I like the 4, because the 4 is basically your total unemployed plus the discouraged workers. So like the U3 is basically your total unemployed. Yeah. It's not going to have those that are out there that are kind of like looking for work, maybe not thinking about it, maybe don't want to work on Christmas, so they don't take the job at Abercrombie or something like that. Sure. I know that was your problem. It's like
I did have a friend that worked at Abercrombie. He was an outside the store model. So
he was good looking, and he also got fired on Christmas Day.
Guy.
He was very skinny, and it looked like speaking of eating, he looked like he could use some rotisserie chicken.
He sure could have.
The point is that, like, if you look at that number, the U4 at 4.9%, that is true, that like that number is well higher than, say, 4.2% at this time last year, for example.
So my question is, between the U3 and the U6, or the U4 and the U6, is this delta at an all-time high as well? I mean, if all the figures are higher than normal, are they usually this far apart? In terms of the unemployment
delta,
rate?
Delta. Can I help you?
You love the delta.
Delta. Yeah, try Delta. Whatever. You know how that goes. No, it's not an all-time high. I mean, there's been times like when we had shocks to the economy. Sure. I mean, you look at 2001. You look at 1994 was another one. You look at 2008. But if you look back to how the speed of this is to start to catch up. Like, we were at this time in September, at the U6 number, we're at 8.0. Now we're at 8.7. So this is moving fast. And so it's just one of those signs that shows you it doesn't back up what some of the economic data has suggested. And so it makes me a little bit concerned now if we continue to get this kind of, let's say, malaise, or just this sentiment that the job market maybe really, really isn't that strong. And if these companies are really serious about doing all those layoffs in the future, as far as tech sectors, I mean, seeing tens of thousands of layoffs being announced in a lot of these tech sector companies alone. It's like, okay, what is going to be the fallout of that? And is that really going to come through in short order? Because if it does, I mean, you're going to look at that U6 number. I bumped you that time. Yeah, this is really good. The U6 coup de coup, don't say. It's like, if you look at that U6 number, man, that thing's going to be towards 11% by the time we get out of this kind of slowing growth cycle. And what's interesting, really quick, Jake, about this as we jump on another topic, is like the market reaction to the jobs number was kind of curious to me, because it was mixed. And it's like the market for the longest time wanted to get lower employment growth because they didn't want inflation to be showing up. They didn't want the market to overheat. And then it was like, okay, the Fed can cut rates, all that stuff. The Fed did cut rates. We had 3 rate cuts in a row. We'll talk about that, which was absolutely a disaster. Those sucked. They're not going to be any good. And they're wasted. And now the market basically turned over on that jobs number when we had that jobs number coming out 7:30 this morning Central Time. So, and crude oil's down big. So like all the indicators that are supposed to be followed by the market in theory that we're going to show inflation and scare the market off when it comes to Fed policy are doing that, and they're scaring the market off going down instead of up.
So let's talk about our friends at the Fed and what they will make of this data. So we had like you mentioned, we had a cut last week down to 3.5% is where the Fed funds rate is right now, 3.5 to 3.75. I don't think that they're going to look at this data that was delayed, was maybe partial, maybe not completely perfectly gathered. I don't think they're going to look at this and do anything with it. My feeling is that they are going to move or wait until, I mean, there's not another meeting until January, but they're going to wait until January data comes out for December, and then maybe use that to drive further policy. I don't think that this labor number that came out with higher unemployment and job growth is going to shake the Fed at all. I mean, Powell literally said yesterday before this number came out that they would be looking at the November data skeptically because of the shutdown and because of the gathering of the data and it being delayed and probably impartial, or I mean incomplete. So what do you, I mean, I know we know that you think that the 3 cuts were wasted. What's a prediction for January?
After this number, I mean, you're going to get a January number that's going to be on target as far as there's going to be timing correctness on it, so they're going to be on time with that. I'll tell you something else. There's no way the Fed didn't know these numbers, so that's something that everybody can stop talking about, because the Fed knew, and so that's probably why they did these cuts. I still think they're wasted. I don't think the economy is that bad, so I think there's a lot of times that we could wait on a lot of these cuts and then use them maybe more precipitously when we need them. I think the Fed's. I think the Fed's going to. I think the Fed's going to stop cutting. I think they have to, because they've shown their cards. The Fed is going to be turned over really precipitously, to use that word again, in 2026.
Yeah, it's gonna be
We're
a
gonna have
banner
completely
year.
different governorship, completely different chairmanship, and you've got a January meeting in the end of the month, Jake, January 27th, 28th. Then you have March 17th and 18th. The Ides of March. Beware the Ides of March. Caesar, that's his quote. Caesar and Brutus. And then also you have the April 28th and 29th meeting. So you
And
really
then
only have
Powell's
3
done.
meetings in the next 4 months, and Powell's out. I think this is Powell's
May.
last meeting. So that's his swan song. There's not going to do anything there
Yep.
except for like give the guy, cake and cookies and stuff like that. I'll send some flowers. Thank you, Jay, because you actually did okay. Jay did okay. But I think they don't cut anymore. I think this is like this is it. I think they did the 3 that they needed to do. And if you look at things like where the numbers are after where they were when they started, there really wasn't much an effect the Fed had. I know it takes a longer time, but it didn't seem like there was that need for them to go crazy like they did on this. I mean, they went kind of balls to the wall on it, and they didn't need to do that, which you would understand.
Yeah, I mean, I think we coming out of COVID, they were backed into a wall. Interest rates were near zero. They had to raise, and then economic situation that arose from the
Before the election?
precipitous raise,
right.
rise of interest rates led them to have to cut. And so now
Before the
now we're
election,
at
which
this
was
spot.
a big miss because that was stupid and silly and out of character, and then they cut again when it seems to be weird. And so I just think it's a lot of there's a lot of meandering that is going to happen with rates here. The rates the effect on the rates is in the 10-year Treasury note. It's not in the Fed funds rate. Just keep your eye on that. And the 10-year Treasury, bumping around 4.2, 4.15, 4.3. I mean, that's where the rate should be. So people that are home like saying like, oh my God, rates need to come down for this, and this. No, they don't. They should be where they are. They should be staying where they are. They should be moving, and that'll get the market kind of back on its feet versus not. And speaking back on their feet, let's talk about, Jake, something that you get on your feet for, I think on Sundays typically, or maybe Saturdays, because the Bears were playing this fall. Costco. Costco is one of the companies that we talk a lot about on this pod. We talk a lot about it with our parents, our friends, people who don't even know, because I think Costco is one of the most amazing companies, truthfully. I mean, it's fun to shop there, believe it or not. I'm a pretty good shopper. You wouldn't suspect that, at least from the standpoint of me being somebody that can handle it, but I can. And I like Costco. And it's one of those things that we have in our portfolios and at least a couple of strategies. It's like, think about this. Costco came out with the earnings last week, and they showed strength across all the metrics in their sales numbers. The executive members, which are basically your membership, it's a membership type of situation at Costco. You can't just walk in there like you can at like a Kroger's or a Safeway. So you have to get a card. The big members there, which is like the executive club or the big, more costly membership, are accounting for 75% of all their revenues. So like effectively you have like the big people there that are like the more, let's say, I guess at least domestically fortunate, let's say, members there are spending most of the money there. Black Friday numbers were a record 250 million online, and then they sold. Get this, most of this was your number, and then I'll let you take the mic here. 4.5 million pies sold on Thanksgiving. I mean, 500,000 of those had to be yours.
Yeah.
And then a couple hundred had to be mine. And then I don't know, a couple cameraman probably had a couple. It's like 4.5 million pies were sold at Costco on Thanksgiving, or for Thanksgiving rather.
Yeah, I'm not a big pie guy, but I do think, first of all, I think you're probably the number one impulse shopper maybe on the planet. I could see you going into Costco with a list and coming out with 3x the list.
You're not wrong.
You're a valued executive member of theirs. But I think Costco, first of all, it's a great place. I mean, it used to just be like a Sam's Club. You go buy in bulk, and you could do the tasters around the club, and there's
all your paper towels that you
hot
needed,
dogs and stuff.
Your bathroom tissue.
They've expanded into
everything.
You could buy everything.
Contact lenses.
I mean, you could buy outdoor furniture. You could buy
insurance.
I mean, you could buy literally everything.
Glasses.
And I think the executive members thing is a bigger story than just a Costco membership, and those are the people that shop there, because that segment that represents the affluent consumer.
So 100K earners, that sort of thing.
I'm saying more than 100K
okay,
earners.
got it.
So we know 100K today is not 100K 2 years ago or 5 years ago or 50 years ago.
What's it going to be tomorrow then, Jake?
100K in California is below the poverty line for a household.
Well,
so it's
don't live in California, but
I think the numbers that they came out with their earnings report and showing the sales growth year over year and the foot traffic year over year and the percentage of shopping that happens with those executive members keeps going up and up and up. This time last year it was 65%. So you're seeing that this is something that you have beat your drum on for as long as I've known you at this point.
Whoa,
that
awesome.
When you look at consumer numbers and consumer data and the economy, you're not actually looking at the average household.
True.
You're looking at the high earners. You're looking at the high income people, the 1%, and probably the next 2 or 5% after that, because those are the people that are driving economic stimulation. Those are the people spending money. Those are the people shopping. That's what Costco is showing me, which is contrary to a Walmart or Dollar Tree or Dollar General that also came out with good earnings over the last quarter, same sort of sales growth, foot traffic growth. And both of those stores, being Walmart and Dollar Tree, both of their CFOs cited that they are now seeing increased traffic from $100,000 households.
How about that?
That's why that number was so important. I harped on it because, again, $100,000 household earners are not the same as that was 50 years ago. But the point being is that higher earners or middle of the pack earners are now starting to go to Walmart and look for other options because groceries are just so expensive.
I think a $100,000 earner like 50 years ago. I mean, that's like $500K nowadays.
Sure.
Man. So that's insane. I mean, that's like, top.
Think about the power of
1%
inflation,
plus.
Pricing
right.
power.
Yeah. It's true. It's just like, I'd say still the $100,000 earner today in like Iowa or Kansas, Ohio, where I grew up. Yeah. California's got its own economy. I mean, it's like the 8th biggest economy in the world. So like, let's take them out of there. But like, yeah, the 100K earner, most places is still making okay. The funny part too, you made a really good point. The funny part about mean versus average, well, mean is average. And then you have a median consumer, which the median consumer, and you mentioned that, like the median consumer is brought up by the top end.
Yeah.
That's basically the middle number versus the average. And that's where you get like a thing that's skewed when I talk about data, you're right, about median home price. The average home price is what really matters because that's your top and bottom. The median is going to be the number in the middle of the data set. So like you could have 100 numbers in the high end and 10 numbers in the low end. And the median is actually going to be in the middle because it's the median number. So like it's like number, 110 would be like number 56 or whatever. And it'd be like, okay, this is number 56, which is up in the top end, which is not the story, which is about what we're seeing here, which is that's why these numbers are good in the sense of this is the number that matters to me. The high-end consumer is the thing that does the spending. They're doing 80% of the spending in most cases. They're doing 80% of the tax paying. They're usually the ones who are your small business creators, who again are doing 80%. Let's use that number. I mean, it's a little bit skewed. It's a little bit off, but you get the point.
80-20 rules
that are like, I'm using that well. It's like, and obviously vociferously, it's like, those numbers are big because that's your number that you really need to keep in mind for when you're looking at the healthy economy. So I think that basically means that the data remains strong. The takeaway is, though, that the indicative nature of it being, hey, the economy is doing okay for the average consumer, probably not true.
Right.
But if the large numbers and the high income earners, if those guys start to fail, if those job creators on the small business side fail, then we're screwed. And so we still have that going. And in fact, the numbers suggest that those numbers are actually better than they ever been in the last, say, several months, in the last couple of years as we rebounded out of COVID. So I would say the takeaway is when Costco talks, when Costco reports, macro investors should definitely listen and really take away the fact that that's maybe your big harbinger on the economy versus some of the data we went over earlier, because of the fact that it's too spread out.
I agree. And I mean, they literally cited pies sold and pizzas sold over Halloween and Thanksgiving, respectively. I'll be interested to see Christmas tree sales. Like I'll be interested to see eggnog. I mean, what else do you have for
peppermint
Christmas?
schnapps, things like
Seven
that.
Fishes. I mean,
cinnamon bark.
Ham,
that would be great.
ham sales. That's what it'll be. It'll be ham sales.
I
So
would
we'll
love
see
to have
what they
some ham
report
with
for
you.
ham sales. But I think there's, you're spot on with when Costco reports and when Costco has data that comes out. That's indicative of the economy as a whole, not necessarily your average investor.
I got it. And here's the thing, man. Let's talk about the average investor in 2026. Talk to me about some things as far as an outlook for early themes, Jake, that would be something to watch for in the next, let's say first 6 months, maybe 8 months of the year as we kind of go into 26, and some themes that we're going to hit into, just say economically, that are going to come to rise here now that we're almost to January, man. I mean, December's moving fast. It's like you said, the 16th.
Can I give you the one theme of the year that won't matter?
No.
Elections. You've got the midterms.
They won't matter.
They won't matter. You got midterms coming up in September of 26. You have obviously Powell that'll be out of the Fed chairmanship in May. So there's going to be a lot of change in the bureaucracy and in the government. As I've said for as long as we've done this podcast, which is only 3 months or so, but as I've felt now for most of my career, that stuff doesn't matter. Who's in office doesn't really matter for the markets, right? I mean, it obviously matters for policy and other stuff, but
which doesn't matter to the markets.
Okay, when you're talking about your investment, I mean, Democratic or Republican president.
True. And in fact, the numbers are closer than people think. That's fair. Right.
And so that's what I think.
Sloped too,
it's positively sloped. So that's what I think is going to be your theme, that up until May, all you're going to hear about is Jay Powell being out of the Fed governorship or chairmanship. Who's going to replace him? Who's going to replace the other governors? And then once we get through that, all you're going to hear from May until September is who's going to be running in the primaries for the Democratic and Republican Party. And there's going to be some, quick reaction to that based off who is put up there, probably Vance on the Republican side, I would think, if it's not Trump again. That's a joke, or maybe not. And so we'll see. There will be a reaction in the market that'll be quick, but then, we'll move past that. So that's what the theme I think will not matter is these changes in the government, these changes in regulation.
I think we're going to have a lot of trade stuff come up next year too, leading up to the elections. I don't know why.
Finally get some clear data.
Well, maybe. You want to speak of clear. I don't know why you keep mentioning September. The elections are in November. I mean, they're always in November. So September, November, tomato, tamale, rafali. I mean, so just for everybody at home to kind of set everything. November are the elections, and I think it's like November 3rd. So it's November 3rd, 2026. Jake won't be voting, but I think there's going to be a huge change. I think there's going to be a flip over in the Senate for sure, probably the House as well. And it's like there's going to be, there's a lot of seats up for choice here. And let's face it, based on how things went in November of this year, there was going to be, I think, more of a suspected change now than we think there was before. Yeah. Point being, you're right. Policy is small c, but that does affect the Fed, I think, going forward. It does affect the economy. It does affect sentiment. Maybe it doesn't affect those higher end people. That's the other thing that maybe I think is the takeaway too there is that politics don't typically affect drastically the spenders, the taxpayers, and things like that. They make adjustments. They make hiring different plans and things like that, but it doesn't change the overall kind of growth mindset that they have unless things are just a disaster. So I think the reality is that there probably is much ado about nothing there, but I think the tariff stuff is going to start to refire.
Yeah, for sure.
The Fed stuff is going to be annoying as all get out because that's going to be oh my God, it's Jay Powell's last 30 days. What's he going to do? Oh my God, he didn't cut rates this last time. What's he going to do now? And it's going to be such a joke. He's got a great Federal Reserve to go spend the rest of his life in. I'm excited for him. A couple $1 billion worth of spend. No big deal. Nice spot. It's just like your apartment. And I think there's going to be a whole lot of conjecture. I like your takeaway is there's going to be so much noise next year. It's going to be an annoying year. I'm just going to tell you that. There's going to be so much crap out there. And then not to mention the fact that I think people are going to go more crazy over AI like I already have. I think it's awesome. But I think that's going to get more real. It's going to get more close to the heart, close to the vest. And then, people are just going to have a hard time dealing with maybe themselves next year. That's going to be my prediction. But in the meantime, we're going to have a start of the year with a great NFL action as we predicted all year. So that won't be bad. The year's going to start awesome. The rest of the year is going to be horrible after maybe my birthday in June.
What I like about the AI piece is that we might see, hopefully, what we've been kind of banging the drum on is the start of the AI monetization of these deals. So we've seen all of these deals between all the mega caps and all the cloud deals and all of the computing and the software and data centers and microchips and everything that's going on between Oracle and NVIDIA and Amazon and Google and Dell and everybody.
The dolls. AI dolls.
We might finally see some of that spend come through in monetization and earnings reports, and I think that's what the market probably needs if we're going to be concentrated again on the tech side. We are going to need some real life data that AI spend matters and is already being productive and already leading to profits.
And I think
that's what we're going to need if we're going to have a tech concentration. Otherwise, I think you can have the financials and the consumer staples and the consumer, the industrials lead us into next year. I think that's okay to broaden out and still have the market go up. I think it's good, actually.
It probably is good. It's going to include more investors. It's not going to mean that there's going to be a lot of folks that aren't going to get the crazy returns that they got before. But hey, that's the way it goes sometimes. I think it's an interesting take how the AI stuff really needs to be adopted and really needs to be implemented at this point. The profits need to be shown because otherwise, if it doesn't go across that broad base of this kind of acceptance, let's say, or this kind of utilization, then you're going to have AI that's going to slow down some, and that's going to kind of like throw it off course, I think, a little bit. And then also there's going to be this kind of those that AI and those that don't AI. And people are like, do you AI? I AI,
right.
Whatever. And it's like, well, if you don't, then guess what? Then we don't build all those data centers. A lot of those companies don't make it. Some of those fringe companies don't make it. They don't survive. Companies get taken over at crappy prices. Whatever. It could be a weird kind of minefield of AI or to not AI, and that's something that I don't know what to say other than AI because. Let's move to something maybe more fun because AI freaks me out.
There's going to be winners and losers.
Yes,
and we got to move past the hype.
Great point. And as there are in the NFL, Jake, winners and losers, as we talked about, and I predicted it in basically July, August, whenever we started this thing. It feels like an eternity. It's like we started the pod with talking about the NFL and how much we loved it. I know, sweetheart. It's like we talked about how the NFL was going to be parity galore. I mean, it's going to be parity central this year because it just felt like it was a year where there was so many good players in so many different spots. And maybe I was just oversensitized to the NIL and the college football and the concentration that you're getting there. But man, the NFL has been so damn good. I mean, I love the NFL every week. It's just so fun, man. There's so many upsets and so many crazy plays. Props to you guys that are playing the NFL, man. It's been a really fun year.
I will definitely. I've given you your flowers on this take already, but it continues to bear its fruit, especially with you've got the Chiefs eliminated, you've got the Eagles who won last year that are struggling. They just beat the crap out of the Raiders, but that doesn't matter. We'll get to that in a second. But this is, I think, the most wide open playoffs that we've maybe ever had, and I think it could be one where you see a ton of upsets. Like again, I still think so. I'll give you my short list for contenders, and then I want to hear if you disagree or agree with any. Basically, fade
go through
fade or trade my
set?
list.
Okay.
No, I'll just give you a handful of names that I think could genuinely win it. I still think the Rams are the number one team in the NFL. I think the Seahawks defense is incredible, but I think they have a Sam Darnold problem. We'll see on Thursday.
We've seen Sam
we'll see
last
Thursday
year,
night when these two match up again. So I think you've got the Rams that can win it all. The Packers now, I think, have fallen off that list with the Micah injury. I really do. That might be biased.
Crazy,
but I truly
so many
believe that.
This past weekend, too.
And I think genuinely, if I'm skipping the Bears and the Seahawks, the Niners could win it all because they've been there before, haven't gotten over the hump, but they have the guys to do it. And then I go to the AFC, and I think it's the Bills. If the Ravens get in, that's scary. So watch for that if the Ravens do get in. But I think it's a short list of the Rams, the Bills, and the Broncos. I think it's Rams versus Bills in the Super Bowl.
Yeah, it could be. I think the Eagles also could be a threat. I think the Eagles have been there too. I use your same logic. Your same logic as the Eagles have been there. The Niners, it works for the Niners who haven't won. It doesn't work for the Eagles who have won.
The Eagles suck.
Okay, well, I think the Eagles could show up. And I think that's your same argument with a lot of these teams is any given day, I think there's a thing called any given Sunday, Al Pacino and some of the guys.
There is.
Happy Father's Day, Al, ahead of time. It's like for your young child, it's like there's going to be a group of, I think, NFL teams that are going to make a lot of noise in the playoffs. And I will throw the Bears in there. I will. It sucks.
They're very good.
And I'm really pissed
good.
off. They're very good. Yeah, right.
They've graduated to that.
You know what? I think also, weirdly, the Buccaneers could show up and make some noise because the Panthers totally choked it last. But they shouldn't. I mean, Baker's been there in some other facets. And they've got some players on that offense that should be stepping up. And then, frankly, I think you also still got to think about the Lions because even though that changeover from Dan Campbell and some of the staff now on the Bears team, we're showing up big time, which shows you how important coaching is for fringe teams that are almost there. You get a good coach on that team,
for sure.
Bam, you go, and the teams that all the way up there sometimes suffers as the Lions are. But then again, the Lions I think are deserved of and confident of some things to happen for them. So I think it's definitely an NFC win game as far as like the Bills don't scare me. The Ravens are a mess. The Chargers are a joke.
No, they're not
the
good.
Broncos are stupid. I just don't think there's really much there in the AFC. And so like you're going towards the NFC on this one. And I think the playoffs are going to be awesome. And I'm really excited to kind of like get out there and even try to go to some games this year because I think there's going to be massive upsets. And there's still a lot of interesting odds on either MVPs or Super Bowl winners and things like that, where you can get a lot of leverage on some of these teams that are on down, which my tactic would be bet some of those higher, longer odd teams and then start to hedge them out as some of the games go along in the playoffs or as these playoffs get clearer. Because, sometimes with gambling, you don't have to just go all in and go crazy. I mean, that's why I feel like I'm a good kind of portfolio manager in a way, because when you roll with, I know, you appreciate the connection. When you roll with some of these futures bets and just getting crazy leverage, like the Bears what are they now, 28? To 1 to win the Super Bowl?
Seems
Something
like
nuts.
could be right.
Like, that's worth a spot because the Bears are in the playoffs, dude. They're going to be one of, 8 teams in the
Hopefully.
NFC? Like, give me a break.
7, but hopefully.
Yeah, 7. Well, 8 if there's an 8, contending for the last weekend.
Sure.
The point is, they're in. And so they're going to have a playoff game. They're going to have probably a game at home, which is going to be...
They got to win. They got to win a game. I mean, they got to beat the Packers this week, and then they're in firm control of the NFC.
There you go, dude. And without Micah, you just said the Packers are done.
I think what I got 2 things to hit on real quick.
Please.
First of all, your take in July that this was going to be a parity-filled league. My take in July was that the Broncos are Super Bowl contenders. The Broncos have a firm grip on the 1 seed in the AFC. This game last week against the Packers was doubly awesome. 1, because they beat the Packers. 2, because they showed what they haven't really all year, that they could win a shootout. And the offense looked awesome. They've won ugly games. That whole AFC West has been ugly.
Just nasty.
They showed that they could win a shootout. And then the take I've had since week 1 that you tried to push back on a couple times, there's not even a close second. The Raiders are the worst team in the NFL. They had 75 yards this week against the Eagles. That's impossible. That's impossible. They are so bad. They're so much worse than the Titans. They actually play the Giants in week 17. So that's like a battle for basically the number one pick, Raiders, Giants, but they are by far the worst team in the NFL. The Titans are actually showing some offensive life. Like they seem like they're starting to figure it out.
What did the Titans? I mean, because what the Titans
beat the Broncos, or they beat the Browns. Sorry,
yeah,
and
they
then,
beat the Browns, and what they hung with what San Francisco. I mean, whatever.
Not
like
really, but they did
game.
score. They did score.
They didn't. I still think the Titans are just a mess though, because if you look at all their drafting over the last say several years, it's a disaster. The front office stinks there. They're building new stadiums and everything, and they're in a great town like Nashville, Las Vegas, I guess is for the Raiders, and they're just blowing it. And they have a new stadium just like the Vegas does. It's just amazing to me. And Pete Carroll, by the way, who's the head coach of the Raiders, thinks that everything, he thinks that everything's great. By the way, he said, "Oh, we haven't lost the team. We haven't done this or that." Ashton Genty is like the most best running back to come out of the NCAA for like the last like 6 years, or since Adrian Peterson, my man Adrian Peterson.
I knew that was coming.
And they suck. They don't even have a running game. And so it's unbelievable. Geno Smith stinks. He has stunk for his whole career since he came out of West Virginia. And he does also show that like you need coaching, you need an offensive line, and you need a plan. I mean, the offense, I don't even know who the coordinator is. I think they've gone through a couple of them.
It was Chip Kelly.
It was Chip, and then he got fired, which is ridiculous. And so that was stupid. It was the dumbest organizational kind of set of coaching.
I would agree with
and
that.
so that's what you get. And so I think they were just going to move on, but I think the Titans still, in my opinion, we'll see how they finish the year. I still think the Titans were the crappiest team out there. And if you want to, watch them both, and you're going to get sick. Just don't eat first because it's disgusting. Okay, let's jump to Fade or Trade, Jake. I want to do some quick hits, some rapid fire and Fade or Trade. I want you to Fade or Trade the following, man. A late blooming Santa Claus rally, meaning in the markets, the S&P, NASDAQ, whatever, leads the S&P up 2% the rest of the year, 2% plus the rest of the year from here. We got 2 weeks left.
Yeah, I'm going to trade that. We've got this is the last full trading week of the year. Like, as I said, next week will be abridged, but I think that we haven't heard a ton of noise from the pit today. It's generally lower volume towards the last couple weeks of the year. I think we can just mosey on up 2%. I think that's fine, and end at like a plus 17% year for the S&P, which would be awesome. We talked about this in October, and I said we weren't going to get to 20%, but we weren't going to go down from there. Seems like I was right again, obviously. But I mean, we're 3 straight years of 15+ percent returns if we hold where we are or go higher. I think it sets up 2026 to be great because we have had that rotation, but we're still doing well. So I think, I'm going to trade that. We could go up 2% the rest of the year. What do you think?
That was really not rapid fire, but I fade that because it looks like the market's turning over here even as we speak. So forget it. Fade or trade, Jake. Lower interest rates. And the rotation kind of set, the rotisserie, blah, 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 for a small cap driven market, maybe a more mid cap driven market in 2026 versus this large cap tech rally that we had this year in 25 and 24.
I'm going to fade it. I think you've talked about how the Fed funds rate is not actually really affecting the 10-year. So take that into consideration, that the open market is not actually dropping that much. So that you typically lower rates help small caps. I don't think we're going to see rates come down that much, but also I do believe in the rotation, as I've said, but I think that's rotating amongst large caps. That's rotating amongst sectors, not sizes. So no, I don't think smalls are going to retake some runway this year. I think it's still a large cap game, but maybe some different sectors. Where are you at?
I think it's a closer kind of trade though with the smalls, mids, and large. In fact, we may be doing a strategy with some smalls and mids. So I think there's going to be some value there, more so than there's been in the last couple of years total. But I still fade it. I still think it's large cap generated environment until people realize that borrowing costs aren't that high. They're going to still kind of fade the smaller cap stuff and the mid cap stuff versus the large cap because of those borrowing costs. One more fade or trade for me, man, and this is one of my favorite ones. Fade or trade here. Let's see. I mean, we had so many injuries this weekend. Mahomes,
terrible,
Micah, all these guys. I mean, Jackson Dart looked like he got
Adams.
Jackson Dart looked like he got 4 more concussions. The Chiefs and Patrick Mahomes, man. Used to talk about the Chiefs and being still the reign of terror, reign of power. It's like, is that reign over in the NFL because of the ACL? I mean, is it done? The Chiefs done? The dynasty blown over?
7 straight conference championships, 5 Super Bowls, 3 wins. Patrick Mahomes, torn ACL. I'm going to fade that it's over. I think this is really eerily similar to the Pats, where they had the same run. Brady tore his ACL in his 8th year. He tore it earlier, so he was back on time for the 9th year. But I think they'll struggle next year because Mahomes probably won't be ready for the opening. Kelsey's definitely going to retire. They have to reinvent the team a little bit, but I think as long as you have Patrick Mahomes and Andy Reid, you've got a chance. And so I think they'll reinvent themselves and probably have a chance again in a couple years. So I don't think it's over for good, but I think we're on a hiatus.
I agree, and I think there's a lot of players players though that will want to kind of rebalance that whole Chiefs team, man. So they'll be able to get somebody maybe that will come in there and take a place of a Kelsey. Man, Kelsey's got a fun life coming up, doesn't he? He's getting married.
Does. I mean,
maybe some children.
What a second act.
He's not getting hit on the football field. The gridiron is going to be obviously, I think, a lot richer potentially.
He's going to go into acting, I'm sure.
He's going to go into acting, modeling. I think he's coming over to your place for Christmas possibly, or New Year's Eve, which would be a lot of fun at Jake's. You guys can come. And so, I agree with you. I fade that. I think that the Chiefs are going to get sold out here. A lot of people are going to pull the rug out from under him. They're going to say, this is Mahomes. No, you can't do it. Yes, he can, because Mahomes is Mahomes, but he needs people on that team. I mean, you look, since Tyreek Hill left, that has been the same team.
They won after that.
They did, but it wasn't the same team.
No,
they won off defense. It just didn't have the same fire. And so the offense needs a rebalance and a refurb. And I think you're going to get that because Mahomes is still a young dude. He's still a pretty popular guy.
Yeah, so, we'll see if Rashee Rice goes to prison in the offseason. That'll
he's
be
not in prison yet. And I mean, he killed someone. So
no, he did not.
Well,
he just fled the scene.
Okay, I'm sorry.
My topic now, the fourth fader trade, the one that you're going to love. Indiana will win the national championship.
When? What national championship for what? Water polo?
Maybe the one that they're the 1 seed in the college football playoff.
I didn't realize that. No chance.
No chance.
Nope.
Fade.
I like your boy Mendoza. I'm going to fade that all day long because there's too many good teams in the CFB right now in college football that are good like Indiana is, that have a little more experience, and I think that dream dies. I just think it does. Great job in the NCAA Big Ten championship. It was a great game. I mean, Ohio State blew it, but Mendoza's a great dude. There's just a little too much about him that I'm just kind of like, okay, dude, we know you're a good guy. We know you're a great brother, sister, whatever you are, great son, but just lay off the sentiment a little bit, man. It's a little bit much, and you're gonna pay for it.
First of all, I couldn't agree more with that. He's obviously corny as hell.
Cornier than you are.
The Heisman acceptance speech, I was like, this is way too much. But I'm gonna trade this. I think Indiana does win the national championship. You can call it a homer bias, but they're also the best team in the country. I mean, they have the best player who just won the Heisman. They have the best defense. They have probably the best coach,
the best player
in the NCAA. I think they will beat Oklahoma at the Rose Bowl, which I will be at on New Year's Day, and then I think they will beat probably Oregon again. And then what I don't want to see though, the thing that could really cause issues, I don't want to see OSU again.
Well, you will. And
I don't. I think Georgia can handle OSU. Why?
He has the
most touchdowns. He has the most yards.
That has been the case.
He's the best player on the best team.
There's maybe on the better team, but here's the other thing, real quick on Ohio State, Indiana. Let's make a bet on something we're going to wear next year because Ohio State's going to beat Indiana, probably in the playoffs, maybe in the final, or maybe Indiana's going to take care of themselves. Meaning, I mean, I don't know if they're going to see them again, but either way, I'm taking Ohio State over Indiana again. They're going to get it right.
Last fader trade of the day before we get to a random ticker roll from you. 2026 will be a bounce back year for Bitcoin. We're down now to 88,000. So we covered this.
Down?
Yeah, we covered this a couple weeks ago and said that we had found a low. We're still off the lows, but we pulled back significantly again. So 2026 bounce back year for Bitcoin. You fading or trading?
I think it's a volatile year to the downside and upside for Bitcoin, which means that's probably a trade. I think, meaning it's probably a bounce back year because you're looking at the downside pressure that's in Bitcoin right now. It's disastrous, and in other cryptos that will probably get refired. But the thing that's funny about Bitcoin, really quick, is why you see, I think it's struggling more than it is suspected to be struggling at this point. The dollar's gotten a bounce in the last 3 months or so because rates have not gone down. Rates have been cut by the Fed, not down in the open market. Dollar looked like crap all year. They looked like crap the last year. Bitcoin was a nice alternative. Gold was a nice alternative. Gold still is a good alternative, getting love. Bitcoin is not because the dollar is strong.
Yeah, gold, silver, copper still doing well. I'm going to trade this as well. I think Bitcoin does bounce back. I think if we do get lower rates, which I said we probably won't, but if we do see rates come down, that helps Bitcoin. But here's the thing I also think that will help is this theme. If the tech run is stalled, investors are still going to be looking for risk on assets. And like you said, we'll see. We've covered they do and they don't. Like you've said, the exciting returns are not in the other sectors for the most part. So if the tech run stalls and AI run stalls and people are still looking for risk on assets, I think they're going to turn to Bitcoin. So I do think Bitcoin bounces back next year pretty hard.
Great. I think if tech goes down, Bitcoin goes down. A lot of the tech has leverage to Bitcoin, blah, 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 blah. Okay, what's left? Here we go.
Random ticker roll.
Oh, crud. All right, let's do it.
You gotta pull a ticker from the tape.
Huge. That's not any good.
No.
Let's jump to the next one. INDA. I don't even know what INDA is.
We can do that.
Let's do INDA.
INDA.
What is that? Is that India?
That's India.
Okay, well we don't want ETFs.
No, we don't.
Let's go to MA MasterCard. MasterCard right there.
Okay.
Consumer driven kind of stock, which is ironic because they don't have any real consumer related let's say, risk. They have risk that the consumer stops using credit cards, which doesn't happen. I mean, look at how much you use your credit card, Jake.
A lot.
I mean, even my credit card you use a lot, which is shocking. I know about that. And so MasterCard, Visa, those are a couple companies we've owned in a couple of our stock portfolios. Still pretty appropriately valued, got great numbers, great earnings numbers, have reported great numbers from the shopping season that started, probably at the beginning of the year, it seems like. And MasterCard's been great. I think the thing I like about MasterCard and Visa is not only is Visa everywhere you want to be, MasterCard, don't leave home without it, which is not the right slogan. I don't care, because MasterCard has bounced back off some lows that it got down to in November. And it was just because shopping was supposed to be lower. People were worried about the consumer. The point is, you're going to get a lot of volatility in MasterCard because of all these consumer sentiment numbers and whatnot, jobs numbers. MasterCard's always going to be there. Okay. It's going to be there like a great friend. And I think MasterCard's one of those safe kind of blue chip stocks that is always going to have some sort of benefit from the economy, whether it's good or bad, but more so when it's good. But also we think it's good. So therefore, I think MasterCard's a decent shot here to keep performing.
That was extremely long-winded.
Thank you, Jim. I'm trying to get you to not use my credit card anymore.
I'm gonna trade MasterCard as well. It's been a tough go in the back half of the year, but I do think that sets up for probably a better year, especially if we see some cyclicality, which I can't stop talking about, or some rotation.
Or say it correctly.
Rotation. I can't stop talking about. So I think I will trade MasterCard in the next year as probably having a solid year of financials. I think people will still spend. They're in the processing fee business, which is pretty big. I think they do well in 26.
Yeah, great, and beyond. And I think to go beyond that, one more pod I think we've got for the year. So we're going to make it a blowout pod, maybe some recap of the year, stuff that made resolutions, maybe fugly Christmas winners. Jake,
I'm not a big New Year's resolution.
No, you're not, because you never fulfill them, and you never want to talk about them, and they're always a pain point for you.
I always say I'm going to get in the gym. And
this is a step through. Yeah, this is, and you are.
I know.
Very, very good. The calorie gym. We'll see what happens with the next pod, but we got one more, and then that'll be the end of the year. So we'll wrap all that up. We'll get it together. We'll probably try to do the best job we can. I mean, it's been a struggle. But I'm happy to be here with you, Jake. It's made by end of the year interesting. And maybe one more year if we're lucky, but one more pod to do live here, and then we'll kick it off to the next year. So let's finish it up and do it well. At least one pod this year, and that'll be next one. So join us.
Yeah, one more episode next week, a little Christmas gift to send everybody into the new year, and we'll wrap up, as you said.
Stuff to basically pay for your kids so they actually go to bed once in a while around Christmas time.
Thanks, everyone.